The following is a presentation of TFNN. Live at TFNN, the Money Masters. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Tom O'Brien.
Hi, folks. Basil Chapman sitting in for Tom O'Brien. My pleasure to be here. I'm usually here Monday through Friday on market days at 11 o'clock for my show called the Tiger Technician's Hour. So here I am for Tom, and a couple of things that I want to talk about. In the Chapman Wave methodology, just keeping it real simple, let me show you what I'm looking at here. If you find that there's a price that moves down and then turns around, you could start to get a buy signal that goes to a buy mode. And the implication is that you will make at least 4 higher peaks. Peak A from the most identifiable low bar. Then if that pullback that makes the peak does not take out the left side low bar, but takes out the high that was made at that peak A, the moment it takes it out by 1 penny starts leg B. Leg B continues until it makes a peak by having a lower high bar. And that becomes peak B, pulls back. The moment it gets broken by 1 penny, it's liable to go from a buy signal to a buy mode, especially if the technicals, I don't have any technicals yet, you don't need them, but especially if the technicals confirm, and that should take you to a C and a D. At D, other things can happen. Simple. Look at this chart of U.S. Steel Corporation back in, I just grabbed it, I saw it there. It's a naked chart. I've got candlesticks because it's just candles give you so much more information. I could use bars because I'm only using the high and the low. And look at this. The low bar that was made at 21.28 on the 16th of March goes to a peak A, pulls back, peak B, pulls back, peak C, makes a long consolidation, and then whoops, screams up to 27.68 on the 15th of April, then turns around, forms a double top, a pattern that I call, didn't take out that high, pattern that I call the drop bucket or the double top cup formation. If the cup formation takes out 1/3 of the cup on the way down, especially if at 1/2, there's a real good chance it's going to touch the bottom of the cup. If it takes out the bottom of the cup, there's a good chance you get a 1-to-1 expansion to the downside. That's exactly what happened here. Now let's get out of this. It's not what I wanted to do. I wanted to go straight through all the different indexes. We'll start with the dollar because it is really quite important here. So first of all, let me say thank you to John Logan. Great first hour, 8 o'clock till 9. Then a fabulous hour with Larry Pesavento, 9 o'clock to 10. I hope that I can give you as much information as they have given you. And I'll be here 10 o'clock Eastern today until 11. And then 11 to 12, I'll do my own show, the Tiger Technician's Hour. And then it's followed after that by Daryl Martin. You've got Dave White. You've got Tom O'Brien back again. So we've got a really full roster. The dollar right now is down just 8 cents at 95.36. This is kind of important. Why? Let me show you the pattern. There are familiar patterns that repeat over and over. Remember, the market is really a price point of human emotion. Even though there are computers involved, it's really human emotion. Look what's happened. You've got a cup formation failure that went from the 100.39 high of the 13th of March, another huge cup failure that went back to over, this time it was only about just over a 50% retracement from the 93's low to the 97's high. That was peak B with a doji candle on the 27th of May. Then it pulls back, and now it's trying to form yet another one, but this time it's only gone about 1/3 of the distance from the low bar of 93.56 from that high that was made in 97.78. The high yesterday was 95.64. But it's holding very well. The 120-minute chart, did I finish? Yep, made a peak D. Remember we were talking about those peak Ds? That at peak D, other things can happen, but at the same time, didn't have a chance to draw it in. But that high that was made, the peak C minus failure, that's very negative. A C minus, the third highest peak that fails, invariably tests the low bar and actually usually goes lower. So in this case, the high that was made on the 12th at 95.68 was pierced just by no, it wasn't. Missed by a penny yesterday at 95.64. So we've had a little bit of a consolidation. Normally what I'd do is I'd grab my tools, I'd go like this, and immediately I'd go left side, right side price time match. I use the plumb line right there. That low bar will be the plumb line right there. And I'd grab my tools and I'd get the rectangle formation, put it in there, and then I'd click on it to go to a new parallel. I turn it green. Why? Because it's a positive development. And of course, I don't know yet about what's going to happen on the right. All I know is that I'm going to take the first real tool that I have to say, wherever that line meets, I'd like to take the low bar of significance. But I'm going to have to, in this case, take that one. It's a funny kind of an angle, but that's the best one I can take. And I draw it in, and I'd go all the way to that particular high right there. And then I just follow the price. Actually, normally I'd go from that doji to that line there. That's what I would do. That would be an outside way of doing it. This is the inside. It's called the Chapman wave inside wedge. And that would take me to, and that would say that by 3:15 on the 24th, that's today, the dollar should be testing 95.68. Well, lo and behold, it did that a day early. It went to 95.64. So that's the way I would do it, with a cup formation, Chapman wave inside wedge, left side, right side, price time match, and we've accomplished a lot. Now what the dollar is doing is making a little bit of a handle, a cup and handle. Now, one of my favorite patterns, because it always suggests, IBD, the Investors Business Daily, they have a whole course on the breakout from a cup and handle. I have a pattern that I call the cup and ladle, which is way more powerful, because if before you get to a D, you take out in a price time match that left side, right side match, you should go to at least a D, probably even an E, and then come back and retest the lip. The cup and handle says, you know what? If you take that out, you should get a one-to-one match with the handle price. But by the time you recognize everything, it's already time to come back and do the retest. So it's not one of my favorite patterns. Not to say that it doesn't work. If you look at this, there's also an inverse head and shoulders pattern in the dollar. So let's go back from the dollar. We're going to say, acting well, monthly chart is still really strong. It's the weekly chart that's seen a pullback in the technicals. See, very strong pullback in the technicals, but yet the price, even with this recent 2-week decline, has not gone under the 93.13. So remember the H pattern that I was talking about, lowercase h? Well, there it is. And this can turn into a very bullish pattern if it holds and starts to climb high, because if it takes out that arch high in the 90, just about under 98, all of a sudden you've got a pattern that says, whoa, you've turned that lowercase h into another positive cup formation to try to test the left side high bar of consequence, and that's the one going back to the 13th of March. So let's do the Euro, EUR, USD currency pair to see the comparison. Well, all of a sudden, you've got your peak D in the euro-dollar currency pair. It's trading at 1.118 right now. It made a high underneath the previous high. Now, remember, we're looking at exactly the same thing in the QQQ series, struggling to get to just a nominal all-time, well, not all-time high in the Qs, but a nominal recovery high, and it hasn't been able to do that. So in this case, it's 1.14659, the high of the 15th of May. I'm going to remember that. And it only went to 1.14355 on the last rally. So that's suggesting to me that the pattern that I drew a long time ago of the arch formation in the euro-dollar currency weekly chart is unfolding, with the H going to a lowercase m. The monthly chart is still horrible. The technicals are trying to rally, and until it can go to 1.156 above the 9-period moving average in the monthly chart, this has to just be considered bounces. Okay, talking about bounces, let's look at the USD JPY, and that's the euro. This is the dollar Japanese yen, Japanese yen. So there's the H pattern that is trying to form, like the dollar, trying to form a successful turnaround. And if the USD JPY by tomorrow or Friday is able to clear, I'd like to say clear decisively, the 124.434 high that was made on the 17th, if it can clear that, suddenly you've got that pattern that says, ho, ho, we've got ourselves a rebound that could go towards the last I wouldn't say all-time high because the all-time high is, let me just pull this back, way back, 124.13 was the high of 2007, June of 2007. But there is a doji candle now. I am calling this F for now. F is where you got to be real careful. But the stochastic and the MACD and the monthly chart are still very positive. This is going to be the most fascinating month, May. Why? Because June. June is going to be a really important month. Why? Because if the price, now I haven't got long to go, but if the Dow closes anywhere close to the 17,500s, that's going to be critical because I've got a pattern that says a close below 17,500 starts a much deeper correction. It's an intermediate term type correction. So far, we're not even close. The Dow is 500 points above it, but I'm going to be watching this really closely. Now, on the other hand, I'm going to get to the parameters of the Dow and the S&P in a moment, but let me just do this. Let me just say that by all measure and all counts in my USD JPY, I could call, let me just double check, 121.838, 122. So that has to be F. This could be G/C, but everything about the price, not the technicals, but the price of the dollar, Japanese yen currency pair suggests that there should be a higher high above 125.84 for leg D. I'll be back and we'll go into greater detail with the dollar. We'll go to bonds and we'll go to, the dollar, the Dow and the S&P and the IWM. I'll be right back.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
You know what's cool? taking something that's good for you, something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, oil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated fulvic and humic acids, nature's preferred delivery system. They have been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com. Tom takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks. We're back. Basil Chapman sitting in for Tom O'Brien. My pleasure to be here. Usually I'm the next hour, so it's a 2-hour session for me, which is fine. I love looking at all these different charts. Dow's down 66, S&P's down 345. So we haven't done anything yet with the Dow. Let me show you something. For my subscribers to my opening call every day, every single day, regardless of where I am, I do my best to do a very detailed report. In this little paragraph here, I give the nitty-gritties of what I'm looking at. Then I add another paragraph to it. I wonder if I can actually show that. Let me just see. Right there. Is it coming up? Is it coming up? Yep, it's coming up. So the first chart would be this one here. There we go. Move it over. So there it is. So there's this, the inner workings. Then I add a whole bunch of stuff that just I think is really important. It might also give an overview. It might add areas that Greece announcement and all sorts of things like that. But basically what I'm saying is there's an up channel. It's a very gentle up channel. These two trend lines, parallel trend lines. I've also got a price time match here, which is missing badly because it's got until the 26th or 27th to get to the recent high of all-time high of 18,351. Can't say it's not going to, as if it won't happen. You don't know. I mean, the MACD is good. The stochastic stalled yesterday. That stalling says, hey, be careful, you got a day of rest. But at the same time, to go from peak A and then pull back and then just squeak to a B is not that great in terms of the way the technicals were indicating. It should have been much higher. Then again, with all this Greek background, this is actually quite good action because, wow, normally we'd be down 15 to 18 or 20 points on the E-minis, the S&P E-minis before the opening. The market would open down sharply. So someone's ignoring this. I'm going to talk about that in a moment. Let me just go with the Dow because, to me, I've done the Dow just about every day that I've been able to do it if I've been around. And for at least 30 years, I've made a daily call based on the Dow. I do the S&P, I do the others as well, but the Dow is what I focus on. And it's in a trading band. And until it breaks the trading band by starting to close under the 17,650s, I'd even say I really wanted to be closing under the 17,550 area. As soon as it closes under that, all of a sudden, watch out, you've got bad technicals, you've got patterns that are starting to fail, making lower lows and lower highs instead of higher highs and higher lows. That's the trend. The trend is when you get those price points moving up higher, both the base and the highs. Now, this is going to be very important. Why? It's real simple. A break on the upside into the 18,420s that starts to hold says, hey, I have no resistance at the top. I've fooled everybody by saying there is a hazard out there that is Greek, and it's the Fed, and it's this and it's that. I'm ignoring it. I'm going higher. Anybody who's shorted me for 6 years probably doesn't have much money left. I want to keep going higher. There are other things that are going on. These rectangle patterns last a long time. So I'm going to do this and talk about it in relation to the prices. So above 18,400s, a close above that, I have to say, going higher. A pullback below short-term, 17,820-ish area, says watch out. then a close below 17,780 says be careful, and then it'll be 17,600. But I always make a big deal about the VIX index. So let's go to the VIX index, and I'll show you what I'm looking at for Friday's close, because we want to look at the weekly chart. Already, you've had a little bit of a bounce in the VIX index. It's at 1226. It's up 15 cents. It's up 1.24%. And we've already broken below the cup formation that was forming. So that, in a sense, is a negative, except you see the arch formation. You saw that the dollar and the USD JPY made the arch formation and retested and then started to move back up again. So if I move this down a little bit so that it just nicked it yesterday, but today so far it's on the line, you've got yourself a an arch formation right there, another V-shaped arch formation right here. And I'm going to make it as simple as possible, just as I've tried to do for years now, using the VIX index, because the VIX to me is a real simple thing. It is buying intensity and selling intensity. When the VIX goes below into the 13, 12s and then the 11s, that's simply buying pressure. It's selling pressure in the VIX, buying pressure, just like bonds. When bonds go up, yields come down. When bonds go down, yields go up. It's the same inverse pattern, Bach counterpoint, right? When the melody goes one way, theme goes the other. So what I'm saying is real simply, if the VIX index by tomorrow afternoon into Friday starts getting to the 14 area, we are going down in the market. If it stays around here, that's support. Up back, Basil Chapman, target conditions are Dow's down 33, S&P's unchanged.
If you're like me, you're always looking for ways to diversify your financial portfolio. Everbank's innovative market-safe CD can help you diversify while protecting your principal deposit. In fact, Everbank unveiled a new 5-year market-safe power metal CD, which combines the power of gold, silver, and copper. Metal prices are currently low, so this CD could really deliver. Consider the facts. You get exposure to 3 valuable metals in one index CD and have the potential to earn up to 45% capped upside payment at maturity if the metals increase in value across annual pricing dates. And should they decrease? No worries. There's zero risk to your principal here, as you still get 100% of it back. Keep in mind, returns are based on CD performance. No annual percentage yield or periodic rate of interest is paid on the CD. Intrigued yet? The July 9th funding deadline is quickly approaching, so hurry over to everbank.com/TFNN-CD for more information, including important product details and disclosures. Once again, that's everbank.com/TFNN-CD. Everbank is a member FDIC.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com.
TFNN has just announced a brand new morning lineup that is geared specifically for traders in this volatile traders market. Every morning at 8 a.m., John Logan starts things off with his daily program, The Global Market Pulse. At 9 a.m., Larry Pesavento trades the market during the market open Monday through Friday on Trade What You See. At 10 a.m., Tom O'Brien hosts the Money Masters for the hour, and Basil Chapman hosts his Tiger Technicians Hour at 11 a.m. From 8 a.m. till noon every market day, these traders are with you as they provide up-to-the-second market information so that you can make the most educated and profitable trades possible. The new TFNN morning lineup is happening right now. Tune in to see for yourself what kind of actionable trading discussion they have each morning, Monday through Friday, starting at 8 a.m., live only on Tiger TV at TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Do the Money Masters show. So Steve is more comfortable time, I'm sure, at 1 o'clock. And so let's go to the market. Now the Dow's down only 26 S&P's unch. I wanted to show you some of the XIV mentioned in the den just a moment ago. This is the VS Inverse VIX Short-Term Index, or ETF. And it's trading at 50. And it's had a spectacular move from the 25s way back in, was that February or March? Way back in January, February. Okay. The last week of January, beginning of February, it started to base, hit the 200-period moving average, and whoosh, straight up. And when you're looking at this, what it's saying is that the MACD is very good in the weekly chart, and the stochastics at 93%. It would take a tremendous decline to get those technicals to turn down. So under 80% for the stochastic, 13% down, and the MACD to cross negative. I would suggest that at 49, at 50, let's call it right now, you would have to see this in a concerted 2-week down move. It couldn't happen in a day or two. It would have to take a week or two. It takes time to get these indicators to deteriorate. You'd have to see something down to the 43 level. So that's we're talking about 11 to 12%. And the way the market is trying to ignore all the potential bad news, we don't know if it's going to be bad news. Of course, we know it's going to be bad news. It's how they resolve the bad news. That's the issue. So the market is actually ignoring a lot of what's going on. So it's the end of the day, into tomorrow, into Friday, going to be really important. In the meantime, back at the ranch, let me do a couple of things here. I wanted to show you the TLT, which I believe is making that H pattern, trying to test that. It's 116.24. It just has to go to 114.80 to tag the 200-period exponential moving average weekly chart, which has been to before and went down below, but it became a fantastic springboard for a cup formation. It's really like a bowl because it's more flat than sharp, straight down, straight up. A bowl formation that really spiral from the 101 area to the 138 high that was made back in, was that January of this year. So if we're looking at it in that context, what we need to say is, yes, there's been more than a one-to-one decline. Yes, it's coming back down with negative technicals, but the stochastic is trying to flatten out at 14%. And I had a theory way back, I'm talking about 10, 12 years ago, about the eventual Japanization of our bond yields, where they too go to a 0%. But there's been a difference because the United States has basically seen a market go from lows to from the 666 area to the 21. So this is a threefold incline, a rally from the March 2009 low. The Nikkei never did that. And we've also seen a modicum of improvement in the jobs situation. Depends on how you measure, but let's call it a modicum of improvement. And Japan never saw anything like that. They were basically in a recession for 15 years or more. Now they're having a very nice rally. So if you put it into that context, could we see something different? But there's something else that you've got to consider, especially with competition from all these countries trying to vie for your same dollar. They want you to buy their product. And that competition is forcing a deflationary aspect into the marketplace. And we've seen deflation in the commodities. Look at gold, GC, gold. Just hasn't been able to rally. The monthly chart looks horrible at this particular point. Trying to find a base somewhere between 1143 on the continuous contract and 1130s. Let's see if that can hold. I'm not sure if it can, but let's see. But there's been a deflationary aspect to commodities and the commoditization of bond yields. So when I show you this chart of the 31-year bull market, is actually even more. In bonds, the peak E, that peak F that was made in the weekly chart back in 2015 from the 166 area coming all the way down to the 149s, that's quite a dip. But the channel has remained intact. And as long as it remains intact, it says, yep, we can consider that we are having some kind of Japanization of our bond yields. And we'll see what happens. But in the meantime, back at the ranch, make it real easy. If at any point in the next month or two, if bonds start to trade at 145, they've broken the up channel and they've broken the Chapman wave inside track. You see that green and red narrow channel right there at the bottom of the wider tube? Well, if it takes it out, all of a sudden you're looking at something that says, hey, I could come all the way back to the 130, 137, 135 area. So a rally in bonds at any particular time over the next 2 weeks that takes the bonds back into the 154 or tests the 155, 200 period moving average on the daily would say money might be coming out of equities back into bonds, the so-called safety of bonds, but it's becoming more dicey talking about the safety of bonds. The TLT is the same, and that's why I said that the 114.80 level on the weekly chart for the TLT is going to be very important. It's trading at 116.27 right now. So I'd love to get your calls at 877-927-6648. Meantime, let's continue with this analysis. So we've done that. Now, what am I forgetting? I'm forgetting copper. Copper is having a nice bounce here, but I have to consider that it's only a bounce. It is making that H pattern in the weekly chart, in the monthly chart as well. And that's going to be a big clue, because if world economies are starting to slow down, then you will see that copper probably like in some ways a barometer of economic development. If it starts to break, instead of being at 264 right now, up a tad, if it went below 2.50, there's a real good chance it'll test the lows that were made in January, around about the 2.40 area. So I'm watching that very closely, and the monthly chart is suggesting deflationary. Oh, talk about deflationary. Let me show you something. Where did it go? Uh-oh, I knocked it off, and now I'm not going to remember what it is. Oh, no. Oh, no. Oh, no. Yeah, I can't find it right this moment. CCI. Am I going to remember it? FCCI. I don't think I've got this right. No. Okay, it's the Vanguard, the commodity. All right, I had a little yellow sticker on my computer, and all of a sudden it's disappeared. All right, well, I can't do that, obviously. It doesn't matter. It's showing that there are lower prices in the commodities. This is very interesting because Monsanto today came out with a very good report. Monsanto was earlier up about 2-3 points, and now it's down 3 points at 109.52. So this is agricultural products, which says that H pattern is just repeat. Remember, patterns repeat over and over and over. And the pattern that I talk about in the Chapman wave methodology, my CD introducing the Chapman wave methodology, available on TFNN, that talks about the left side low bar being very important when you get an H pattern. Why? Because if Monsanto, going into July, takes out 105 support, closes under it, you could get a 1-to-1, and that would take you down to the 102 to 101 level. So we're going to watch this really closely in the commodity area. All right. Now I have something that I call my Dow Quartet. It's the Dow Quartet Chapman Wave Index. Only 4 stocks. I sometimes add guest artists. I use GE, IBM, Triple M, and UTX. GE is my shorter term indicator, and we're showing yesterday that was good action, which is one of the reasons we nibbled at shorts again today. But didn't get heavy into the short side. I'm trying to save the money because I'd like to get, I want to see price deterioration, and then I'll feel comfortable. So basically, GE, yesterday had a very nice session. Not great, but good. Way above the 9-period moving average. It's just about to hit. Remember, you can use trend lines. I have trend line technique for trend lines that uses the entire wick, not just the body of the candle. And if you go to the top, peak D in GE, it was made on the 21st of May at 27.79, and then the lower high bar that was made at 27.68 on the 10th, and then yesterday's lower high bar. I don't know how it does that at 27.60, but this is absolutely point perfect, tick perfect for making it down. Look at this, 1, 2, 3, 4, it'll be 5 bars today unless it takes it out at the end of the day. 5 bars have hit exactly this great trend line resistance. Now, what I like to do is say, can I make this into a channel? Because it's going to give me even better parameters. Yep, I can. But actually, what I normally like to do is to go what I call the falling axe, which is an expanding cone. This one can work out, but it's really pushing a little bit, because what I really need to be looking at here, is there any chance that we could be looking at GE telling us there's still internal strength and that G is going to retest the candle of May the 21st at 27.79? Because if it does that, that would impart to me enough information to say there's still enough internal support inside here. Be careful on the short side. You can do it gently. You can kind of nibble at your shorts, thinking that you'd like to add because your impression is that over the weekly charts we're going lower. But at the same time, I wouldn't get too heavily short. Why? Because when I'm looking at this particular pattern, the most important thing is that I want to be confident that my indicators are confirming what I'm looking at. So I've got technical indicators that are suggesting, yes, we could be going down, but I also have a couple of iconic indicators that are saying, hey, be a little bit careful here, just at the moment, until you get real confirmation. And what I'm really looking at is that the weekly chart of G suggests there will not be a leg E, a D to the upside. We're really stuck in a trading rectangle formation. So that's GE. Let's go to IBM. IBM monthly chart is looking horrible. It's improved a little bit, but it's still really looking bad. The weekly chart is better, but not great. And the daily chart has got that H to an M pattern, and it's trading down 55 cents at 168. Parameters, very clear. A close below 166 in the next 3 to 4 sessions before taking out 171 on the upside would suggest that you've got an arch formation. You're going to be retesting the 164 to 161 area and probably take it out based on the weekly chart, because that would deteriorate the MACD stochastic solidity to 59%. A close by Tuesday in the 171 to 172 area, I'd have to say, wow. What's happened is in the rotational correction, as certain stocks have deteriorated terribly, they've then taken time to form some kind of a base. And as other stocks that have been fabulous take a breather, so that the laggards suddenly become buys again. So let me do this. This is so IBM, those are the parameters right now, still looking poor. And Triple M had a good day yesterday, but it's still got a lousy chart pattern. The daily, the weekly, and the monthly is still very good technically on price, but not in the stochastic and MACD. That's suggesting we're going to be coming down at some point if Triple M, which is trading down 60 cents at 159.24, takes out 157 to 155 support in the next 2 weeks. And finally, UTX, Now, my other bellwether intermediate term is looking very poor with an H. How many H patterns can you get? Remember, patterns repeat. They are fractals of human emotion. You get euphoria and you get pessimism, and it just basically switches from the one to the other. And if UTX trading down 94 cents at 114.29 takes out 113 support, the left side low bar, it says be careful because 112 to 108 would be the next larger intermediate term target. All right, and on the upside, if in the next 2 weeks, it actually has a great rally and goes to 120, I'll have to admit, wow, internal strength remains. The sideways 6-7 month consolidation could see us start to break out to the upside. I'm not sure that can happen right now. So a couple of questions in the den. CVCO, I don't think I've looked at CVCO. Let's just see what it is. CVCO is Cavco Industries. I don't think I've even heard of it. It's an ABCD, recycles ABCD in the daily. It goes to, on the 15th of June, CVCO trading at 77.26, up $1.76. Hits a high of 78.01, pulls back, makes the cup formation, and it should be retesting. Once it gets halfway into this particular candle, which it is, says there's a good chance it's going to try to test the 78.01 high. But the weekly chart is the one that really stands out to me. Why? Because it's got the H pattern that has been quite successful, and I've got to be ready to say, now you might be able to turn it around and get a cup formation. But I'm going to be very, if you're long CVCO, I'm not sure if you're long or if it was just a question of manufacture of housing, it should be doing much better, especially with rates still very low. I would suggest to you that if you're long, I would just put a stop in some of my position. It's in 77.26. If you've got a full position, if it closes under 73, I take a little bit off. I think it's going to go lower than that. But holding right now, let it go. But the big challenge is can it cross 2? That's quite high up from here. I'll be right back. Basil Chapman sitting in for Tom O'Brien, the Money Master Show. I'll be right back. Dow's up 26.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Hi, I'm Steve Rhodes, host of the Trader's Edge heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Catch Basil Chapman as he uses his Chapman Wave methodology to call the markets. The Tiger Technicians Hour, next on TFNN.
Hi, folks. We're back. Basil Chapman, Tiger Technicians Hour. So this is what we've got. I want to just do this as it happens, live. We're looking at the QQQ series, having made a new, so that's an ABC. So that's leg D in the QQQs at 111. 13. It needs 4 cents. 4 cents to go to get to 111.17. It's being helped considerably by Facebook, and Facebook right now is at. See, once we get all these D's and E's in the daily charts, it says at this particular point you've got to be careful because there could be a pullback. We're ready. At the same time, Facebook's up $1.29. Wow, I showed this to my subscribers yesterday morning before the opening. It was right here, that bar right there. And I drew this in to say there's a cup left side is a Chapman wave, left side, right side price time match. The right there was the plumb line. This is right there. The low bar is the plumb line right there. And it would be perfect because it has a Chapman Wave inside wedge that takes you to the 29th of June to break above 86.07. But I didn't want to trade it because leg D is kind of dangerous because it could go there and then turn around on the same day. We've seen that before, except this opened. Could actually have got it. What was the close? 80. The close on the 22nd was 84.74. No, I would have missed it. And the low on the 23rd was 84.76. I would have said just a little under the close, and we wouldn't have been able to get it. So I would have missed it anyway. But look what happened. This move went from the 84 60s to the high today, which is 89.25. That's very nice, a 5% gain in just 2 days. 3 days. So Facebook is carrying the day, and this is what we're seeing. The rotation that we've seen over the last 6-7 months has had going from stocks that were just meandering and doing nothing but holding okay, but they weren't doing anything, to suddenly spiraling higher. And that allowed for, within even a sector that was looking weak, a handful of stocks to go higher. If we're looking at Netflix, so it's D in the daily, D in the weekly, D in the monthly in Facebook. If we're looking at Netflix, just spiraled higher in F/C, E in the weekly chart, and G/B in the monthly chart. And the monthly chart still looks great. The weekly chart looks really good. And the daily chart was looking very poor with the technicals weak, but price held the 9-period moving average, that black line there, and pow, it's gone higher. Up 1466, had a high today of, it opens at 700.10. Goes to 706.24. And so this is going to be very interesting because we're seeing all of these stocks that are very important to the overall market suddenly come alive, and then they don't just come alive, they become absolute leaders. And now this is new tech becoming leaders. There was a period just recently where the Microsofts, Oracles, etc., were becoming old tech leaders risen from the dead back from the 2000 crash. That was amazing. So I'm watching this so closely. Now, I had spoken, we had a caller yesterday, Tony from Wellesley. I was looking at the IWM, and I said, if ever there was an opportunity in the IWM based on my work, going to a trend line resistance in leg D, because it had just made that D a couple of days before, a leg D, and went to now, so 129.09 yesterday, 129.10 today, 1 penny higher, it's still leg D. The 120, what is that? Oh, that's a break. That's the end of the show. How time flies when you're having fun. I will continue with these thoughts when we get back for my show, the Tiger Technicians Hour. Thanks so much for being here. And this is the Money Master Show for Tom O'Brien. And he'll be back tomorrow. And I'll be back for my show in another 5 minutes. Stay tuned.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This is TFNN.